commercial real estate market entering 2026 looks very different than it did just a few years ago. Capital is more selective, tenants are more demanding, cities and suburbs are being repriced based on how people actually live and work, and not on how they did in 2019. For owners, developers, and occupiers alike, success in 2026 will depend less on chasing trends and more on understanding the structural forces reshaping demand, underwriting, and long-term asset performance. Below are 6 commercial real estate trends that are already taking shape and will likely define commercial real estate markets in 2026. First, in 2026, the strongest commercial assets are increasingly those that support core business operations, not the financial instruments that were especially attractive to investors during the high liquidity surges of recent history. That means much more likely you'll find value growth from assets tied to manufacturing, cold storage, life sciences, healthcare, and mission-critical data uses, which will increasingly outperform other asset classes. This shift reflects a broad repricing of risk. Assets that are embedded in supply chains or essential services benefit from longer lease terms, higher switching costs, and greater tenant stickiness. As a result, investors should prioritize underwriting cash flow durability rather than upside speculation, while tenants who prioritize proximity to labor and operational efficiency over prestige addresses will likely find success as well. By 2026, it's not accurate to speak about the office market as a single category. There's a vast divide between high-quality, well-located, amenitized buildings and commodity office space. Class A offices with strong transit access, natural light, flexibility, floor plates, modern HVAC systems, and thoughtful tenant experience programming, they're leasing, and they're leasing at high rates. Commodity and Class B and C offices without clear investment strategies are struggling to retain tenants, and they're often competing primarily on price or seeking to reposition as land plays. Therefore, more than ever before, the office market is a tale of two cities. And if you're an investor, there's one city that you would much rather be in than the other. Industrial real estate entered 2026 after several years of rapid expansion. While headline absorption has moderated, the underlying fundamentals remain strong. Nearshoring, inventory rebalancing, automation, and last-mile distribution continue to support demand across most major U.S. markets. However, what has really changed is selectivity. Tenants are more price-sensitive and more disciplined about facility specifications. Clear heights, power capacity, trailer storage, dock ratios, and zoning flexibility matter more than ever before. Secondary locations without infrastructure are falling behind. From an investment perspective, the market is rewarding assets that can evolve. Buildings capable of accommodating automation, heavier power, or multiple tenant profiles are commanding premiums in the market. Inflexible, shallow bay, or functionally constrained facilities are facing longer lease-up times. For developers and owners in the industrial asset class, success in 2026 is less about building for volume and more about building for optionality. And for tenants, it's time to be more selective. Find a space that really works for you and your business. Don't just rush out to find space because you don't want to get left out in the cold. Adaptive reuse has moved from opportunistic to strategic. Across office, retail, and a wide array of other institutional asset classes, owners are looking at reevaluating if their assets can be repositioned rather than replaced. However, successful reuse projects require deep due diligence and coordinated execution. You have to understand floor plates, ceiling heights, loading capacity, mechanical systems, zoning overlays, and ultimately, it's a very complex process. So for investors that are looking to convert functionally obsolete asset classes, it's important to do your due diligence. Not every office can be converted to residential. Not every retail project can be converted. And certainly, at the end of the process, it often costs a lot of money, or you might have to take a haircut. In 2026, data is no longer a competitive advantage, but an expectation. For investors and occupiers, they expect real-time visibility into operating costs, energy usage, occupancy, and portfolio performance. Property technology adaptation continues to accelerate, particularly in asset management, leasing analytics, and predictive maintenance. Tenants are increasingly looking for clarity around total occupancy costs, not just base rent. Investors are scrutinizing operating efficiency and capital expenditure forecasting with greater rigor. This trend is reshaping relationships across the industry. Owners who can provide transparency, build trust, and retain tenants, and advisors who can interpret data, not just present it, are increasingly valuable. Decisions are being made much faster, with less tolerance for vague assumptions or gut decision making. As a result, how firms handle data over the next few years will define success trajectories for most of the industry. Perhaps the most defining trend of 2026 is the shift in capital behavior. After years of cheap debt and aggressive underwriting, investors are now prioritizing durable downside protection and realistic exit assumptions. Debt markets remain selective, equity partners are demanding clear business plans, conservative rent growth, and demonstrated operational expertise. Assets that rely on aggressive future appreciation rather than current cash flows are facing increased scrutiny. This environment favors an experienced operator and a patient capital holder. Also, it rewards markets with diversified employment bases, infrastructure investment, and demographic stability. For buyers and sellers alike, pricing clarity matters, and it matters more than momentum. Advisors who understand both capital markets and on-the-ground leasing dynamics are best positioned to guide clients through this challenging period. Commercial real estate in 2026 is not about predicting the next big trend. It's about adapting to a more rational, operationally focused market. A market where execution matters as much as vision. The industry is not contracting, it's maturing. And those who recognize the shift will have a meaningful advantage going forward. For a consultation on the future proofing of your real estate assets, reach out to our team of commercial real estate agents for more tips and tricks. Contact us below.